1. Currency. The social illusion of money. Imagine you're holding a $100 bill. It's just paper with green ink, yet it can buy groceries at Walmart, pay for gas at a Chevron station, or cover part of your phone bill with Verizon. Why? Because everyone in the United States agrees it has value. That agreement is fragile but powerful. Centuries ago, people bartered directly, trading salt, tobacco, or cattle. Later, gold and silver coins became the standard. Today, most transactions aren't even physical. You swipe a card, tap your phone, or send digital numbers across a screen. Bitcoin and other cryptocurrencies push this idea further. They have no physical form, yet millions treat them like gold. The truth is simple. Money is a story we all believe. In the US, the Federal Reserve manages this story. The government prints currency, the Fed regulates supply, and society uses it to trade. But balance matters. If too much money floods the system, inflation eats away at your savings. Your $100 buys less groceries than last year. If too little circulates, businesses struggle, unemployment rises, and people can't afford daily life. Think of currency as trust. A dollar bill is valuable only because you trust that others will accept it tomorrow. That trust is the invisible glue holding the American economy together. Without it, the system collapses into chaos, like trying to pay for Starbucks with seashells. 2. Banks. The middlemen of money. Walk into a U.S. bank with $10,000. You might imagine it locked away in a steel vault. In reality, that money doesn't just sit there. The bank lends most of it out, maybe to a family buying a car, a student paying for college, or a small business expanding. This system is called fractional reserve banking, and it works because not everyone withdraws their money at the same time. Banks make their profit by charging borrowers higher interest than they pay savers. If you deposit money, you might earn a small interest rate, but when someone else borrows that money for a mortgage or credit card, they're paying much more. That difference is the bank's business model. For everyday Americans, banks offer 3 big benefits. Convenience. You can pay bills online, swipe a debit card, or transfer money instantly instead of carrying cash. Safety. It's far safer to keep money in a bank than under your mattress. Insurance. In the U.S., deposits are insured by the FDIC up to $250,000 per person. That means even if the bank fails, the government guarantees your money up to that limit. Think of banks as traffic controllers of money. They keep it moving, circulating, and growing. Without them, the economy would stall. But when too many people panic and withdraw at once, as happened during the 2008 financial crisis, the system shows its fragility. Lines formed outside banks, trust collapsed, and the government had to step in to stabilize the system. Banks aren't just vaults. They're engines that keep money flowing through the economy. They connect savers with borrowers, turning idle cash into active capital. And while they can stumble, especially in times of crisis, they remain one of the most important middlemen in modern American life. 3. Inflation. The silent thief. Picture this. Last year, a bag of chips at Walmart cost $3. Today, the same bag is $3.75. Same product, same size, but your money buys less. That's inflation, the slow erosion of purchasing power. Inflation happens for several reasons. Demand outpaces supply. Everyone wants the same product, but there aren't enough to go around. Prices rise. Production costs increase. If fuel, shipping, or raw materials get more expensive, companies pass those costs to consumers. Expectations. If people believe prices will rise, they rush to buy now, which ironically drives prices up even faster. In the US, a little inflation, around 2% per year, is considered healthy. It encourages people to spend and invest rather than hoard cash. But when inflation spikes, everyday life gets harder. Savings lose value, wages struggle to keep up, and essentials like rent, groceries, and gas feel heavier on the wallet. Think back to 2022, when inflation in the US hit levels not seen in decades. Families noticed their grocery bills climbing, rents rising, and even fast food meals costing more. Suddenly, the same paycheck didn't stretch as far. So how does the government fight back? The Federal Reserve raises interest rates. That makes borrowing more expensive. Mortgages, car loans, and credit cards all cost more. Higher rates cool down spending, slow demand, and eventually bring prices back under control. Think of inflation as erosion. It doesn't destroy overnight, but over years, it reshapes your financial landscape. A dollar today won't buy the same tomorrow. That's why understanding inflation isn't just economics, it's survival in the modern U.S. economy. 4. Value. Why some things are worth more. Think about gold. It's shiny, rare, and people prize it. Yet at the end of the day, it's just another rock pulled from the earth. Compare that to a regular stone you'd find in your backyard. No one's lining up to pay thousands for it. The difference isn't in the object itself, but in the value humans assign to it. Luxury brands like Gucci or Louis Vuitton understand this perfectly. A handbag from Target might carry your wallet and keys just as well, but the luxury version sells for 100 times more. Why? Because people perceive it as more valuable. That perception, status, exclusivity, prestige, is what drives the price. In the US, value creation is the engine behind wealth. Doctors and lawyers earn high salaries because their skills solve problems people desperately need solved. Innovators like Steve Jobs built fortunes by creating products, like the iPhone, that millions of people decided were worth thousands of dollars. The product itself is just glass, metal, and circuits, but the value it delivers, connection, convenience, identity, is enormous. Here's the secret: wealth follows value. If you can create something people want, or even shape the way they perceive its importance, money flows toward you. Sometimes it's tangible value, like curing a disease. Other times it's perceived value, like a luxury brand convincing you their logo makes you special. Value is the invisible currency of modern America. It explains why a Starbucks latte costs $6 when you could brew coffee at home for 50 cents. It explains why people pay hundreds for sneakers endorsed by athletes. And it explains why some entrepreneurs become billionaires while others struggle, because they've mastered the art of creating or amplifying value. If you want to build wealth, don't just chase money. Focus on creating value, real or perceived, because in the US economy, value is the magnet that pulls dollars in your direction. 5. Interest. Friend or foe? Interest is like rent for money. When you borrow, you're paying rent to use someone else's cash. When you save or invest, you're the landlord. You're collecting rent for letting your money work. There are two main types: simple interest, a flat fee. Borrow $1,000, pay back $1,100. Straightforward. Compound interest, the real game changer. Every dollar earns interest, and then that interest earns more interest. It's money cloning itself over time. For borrowers, compound interest can be brutal. Take credit cards in the US. Many charge 20% or more annually. Miss a payment, and suddenly that $12 fast food meal balloons into $50 of debt. Small mistakes snowball into financial disasters because interest keeps piling on. For savers and investors, compound interest is magic. Imagine putting $1,000 into an investment that grows at 7% annually. In 10 years, it's about $2,000. In 20 years, it's nearly $4,000. In 30 years, it's over $7,500. That's the power of time and compounding. Your money multiplies quietly while you sleep. This is why Albert Einstein supposedly called compound interest the eighth wonder of the world. Those who understand it earn it. Those who don't, pay it. The rule is simple. If you're paying interest, kill it fast. Pay down credit cards, loans, and debts before they spiral. If you're earning interest, let it sit, feed it, and give it time. Patience turns small savings into big wealth. In the US economy, interest is either your worst enemy or your best unpaid employee. The choice depends on which side of the equation you're on. 6. Investing. Making money work for you. Inflation is like a slow leak in your wallet. Over time, the same $100 buys fewer groceries, less gas, and fewer essentials. If you only save money in a checking account, inflation quietly erodes its value. The antidote is investing. Putting your money to work so it grows faster than inflation eats it away. Instead of trading hours for wages, investing lets you trade money for more money. In the US, there are several common paths. Stocks. When you buy a share of Apple or Tesla, you own a tiny slice of that company. If the company grows, your slice becomes more valuable. Stocks are volatile, but over decades, they've historically delivered strong returns. Bonds. These are loans you give to governments or corporations. In return, they pay you back with interest. Bonds are steadier than stocks, often used to balance risk in a portfolio. Funds. Mutual funds or ETFs bundle dozens or even hundreds of stocks and bonds together. Instead of betting on one company, you spread your risk across many. Think of it as buying the whole basket instead of one apple. Real estate owning property can generate rental income or appreciate in value. From single-family homes to commercial buildings, real estate is a tangible way to grow wealth. Investing isn't gambling. It's about patience, diversification, and discipline. Wealthy Americans didn't win the lottery. They gave compound growth decades to do its work. A modest investment of $200 a month, consistently placed in an index fund, can grow into hundreds of thousands of dollars over a working lifetime. The biggest risk isn't losing money. It's never investing at all. If you sit on cash, inflation quietly steals your future. But if you invest wisely, you harness time and compound growth to build wealth. Think of investing as planting trees. The earlier you plant, the sooner you enjoy the shade. And in the U.S. economy, those who plant consistently, stocks, bonds, funds, or real estate, are the ones who retire comfortably, while others wonder where their money went. 7. Recessions. The economic reset. A recession in the United States is defined as the economy shrinking for at least 2 consecutive quarters, 6 months of decline. It's more than just numbers on a chart. It's felt in everyday life. Jobs disappear, businesses tighten their budgets, and families cut back spending to focus only on essentials like rent, food, and utilities. Think of the economy as a party. In the boom phase, everyone's dancing, buying new cars, booking vacations, and splurging on gadgets. But eventually, the lights flicker. Reality sets in. Someone checks their bank account, businesses notice sales slowing, and suddenly the music changes to something somber. That's the recession phase. The party isn't over, but the mood has shifted dramatically. Recessions can be triggered by many factors. High interest rates. When borrowing becomes too expensive, businesses stop expanding and consumers stop spending. Global crises, wars, pandemics, or supply chain breakdowns can ripple through the U.S. economy. Natural cycles. Economies naturally move through boom, peak, bust, and recovery. The 2008 financial crisis is a clear example. Housing prices collapsed, banks failed, and millions of Americans lost jobs. More recently, the COVID-19 pandemic caused a sudden recession as businesses shut down and unemployment spiked. Governments and the Federal Reserve often respond with tools to soften the blow, lowering interest rates to make borrowing cheaper, stimulus checks to put cash directly into people's hands, business support programs to keep companies afloat until demand returns. Recessions hurt, but they also reset the system. They clear out inefficiencies, force companies to adapt, and eventually pave the way for new growth. Recovery always comes, though scars remain. Lost jobs, closed businesses, and financial stress for families. In the U.S., recessions are painful reminders that the economy is cyclical. The party doesn't last forever, but when the lights come back on and the music picks up again, growth resumes. The key is surviving the downturn so you're ready to thrive when the next boom arrives. 8. Credit scores. Your financial reputation. In the United States, your credit score is like a financial reputation condensed into 3 digits. It ranges from 300 to 850, and it doesn't measure how rich you are. It measures how trustworthy you are with borrowed money. Lenders, landlords, and even some employers use it to judge reliability. Here's what shapes your score. Payment history. Do you pay bills on time? This is the single biggest factor. One missed payment can drag your score down for years. Credit utilization. How much of your available credit are you using? If your credit card limit is $10,000 and you're constantly maxed out, lenders see risk. Keeping usage below 30% is considered healthy. Credit age. How long you've had accounts open. A 10-year-old credit card looks better than one opened last month. Credit mix. Variety matters. A mortgage, car loan, and credit card show you can handle different types of debt. New credit. Too many applications in a short time raise red flags. It looks like desperation. A strong score, typically above 750, unlocks better loan terms. You'll qualify for lower interest rates on mortgages, car loans, and credit cards. A weak score, on the other hand, makes borrowing expensive. You might still get approved, but you'll pay thousands more in interest over the life of a loan. Someday, that score might help you buy a home, finance a car, or start a business. Here's the catch. You can have zero debt and still have a poor score if you don't have a credit history. In the U.S., the system rewards participation. It's not just about being good with money. It's about looking good to lenders. The game may feel rigged, but if you learn the rules, you can rig it back in your favor. 9. Taxes. The price of civilization. Taxes sting when you see your paycheck shrink. You work hard, maybe 40 hours a week, and then the stub shows deductions. Federal income tax, state tax, Social Security, Medicare. Suddenly, that $2,000 paycheck becomes $1,450 in your bank account. It feels like money disappearing into thin air. But here's the truth. Taxes are the price of civilization. They fund the systems that make everyday life possible. In the U.S., taxes build highways and bridges, keep schools running, pay firefighters and police, and ensure the food truck on the corner isn't serving rat-infested tacos. They even fund billion-dollar defense programs that most of us will never see directly. There are many types of taxes Americans face. Income tax, taken directly from your paycheck. Sales tax added when you buy goods at stores. Capital gains tax, applied when your investments grow and you cash out. Payroll taxes, Social Security, and Medicare contributions. Social Security is like forced retirement savings. You pay in now, and later you receive benefits. Medicare helps fund healthcare for older citizens and those with serious medical needs. And then comes the ritual of filing taxes. The government already knows how much you owe, but it makes you guess. If you're right, no problem. If you're wrong, penalties and audits loom. That's why tax season in the US is dreaded by millions every April. Yes, taxes are frustrating, but without them, the lights go out. Roads crumble, schools close, hospitals struggle, and public safety disappears. Countries with higher tax rates often enjoy better health care, stronger education systems, and more reliable infrastructure. Think of taxes as the membership fee for living in a functioning society. Painful, yes, but necessary. They're not just deductions on a paycheck. They're the invisible threads stitching together the American way of life. 10. Time, the ultimate asset. Time is the most valuable resource in America. And unlike money, it can't be replaced. You can lose $100 and earn it back tomorrow. But once an hour passes, it's gone forever. That's why time is often called the great equalizer. Everyone starts with it, but not everyone uses it wisely. Most people trade hours for wages. Work 8 hours, get a paycheck? It's simple math. But the wealthy have learned a different game. They leverage skills, systems, and investments so their time generates more value. Instead of trading 1 hour for $20, they build businesses, create products, or invest in assets that keep earning even while they sleep. In finance, time is the secret weapon. Compound growth doesn't work overnight. It needs decades. That's why ordinary Americans with modest paychecks can retire with millions. A teacher who invests $200 a month in an index fund starting at age 25 could retire at 65 with over $1 million. Not because they were lucky, but because they gave time room to work. Think of time as a multiplier of wealth. Money invested today grows slowly at first, then faster, then explosively as the years stack up. The earlier you start, the greater the effect. That's why financial advisors in the US constantly stress, don't wait, start now. But time isn't just about investing. It's about life choices. Do you spend hours scrolling social media? Or do you spend them learning a skill that could double your income? Do you trade all your time for wages? Or do you build systems that free you later? Time is the one asset no one can buy more of. Use it wisely, and it becomes your greatest ally. Waste it, and it becomes your greatest regret. In the American economy, time is the invisible force separating those who just get by from those who build lasting wealth.